in the pre-market, in the early portion, Bitcoin was trading nicely higher. And then as soon as the stock market started to sell, Bitcoin started to sell as well. So that's going to continue. The kicker for me is that I do think we have an inversion coming where all of a sudden Bitcoin starts to take on more of a safety asset. So as you slip into recession, stocks by default will have less consumers buying their product, and their earnings are going to continue to drop. Now, fund managers are going to have to say, listen, I have to stay invested, so where do I go? I think the first thing we have to recognize is that this will be the year, and probably in the first quarter, where the Fed stops raising rates. No one should expect them to cut rates. They're going to be very, very hesitant to do so because inflation is still well above that 2% level. But at least the markets will get jittery and excited for that aspect. And I think that'll be a short-term catalyst if we get that word from the Fed that they're finally done raising. The next thing that I think is going to be a tremendous kind of shock to the market is that we are going to slip into a recession in 2023, and it's going to actually turn out to be a very rough recession, right? We obviously know that past recessions since 2009, the Fed has come out, printed money. They can't do it this year. So there's going to be a point later this year, probably in the third quarter or fourth quarter, where the market and investors are going to say, uh-oh, if the Fed won't save us, how do we get out of this recession? We don't know how. We don't know. We're like it's like the parent and the child. The parent always saves the kids. When the parent leaves, what happens to the market here? So this is my S&P 500 chart. Today, we are seeing a nice little down day. There is a bearish pattern formation here, so that does dictate further downside over the next week or two. But really what I'm expecting is a move probably within the January or February month to 3,400 on the S&P. And then obviously after that gets a bounce, you'll be looking at this long-term trend line. Take a look at this trend line. It goes all the way back to 2009. Connects through these lows. Here was your COVID pierce. That just panic was just insane there. But this is probably where we're headed. So we're looking at a 3,000, at least I'm looking at a $3,000 target on the S&P 500 this year alone in 2023. And then let's not forget about crypto. I mean, crypto probably bottoms this year, but it's going to be a very volatile yield. You're going to have some pops in crypto. You're going to have some dips. You will probably hear about regulation in 2023 as well. And I think that's going to really send the market into kind of a tizzy in the near term. Then I ultimately think we'll probably end up in a period where we're below trend, right? So if you think about it, there's a name for the line, which is a trend line, which tells you where the trend has been. And we've been above the line for such a long time, ever since 2009, when the Fed started printing money. And so the idea is that if you're above for a long period of time, it makes sense that you could be below to even it out and be below for a significant amount of time. So even though for my year target, I'm kind of looking at that 3,000 level, I think over the longer term, the next couple years, we actually could go below that level. It could be a pretty nasty. There's two things that could trigger the Fed to start printing or lowering rates. One would be, needless to say, some sort of massive recession or depression, or it could just be the fact that inflation gets down to 2%. And right now, the Fed is like, oh, it's got to go to 2%. But that's a moving target. Let's be fair. Like if we got in a Great Depression like type scenario, they're not going to be like, oh, we're at 2.1%. We can't cut rates. Or print money. They're going to do it when you have unemployment skyrocketing. So I think the key is, though, investors need to understand it's going to have to be a shock to the economy to get them off of the bench, essentially. And that's not going to happen in the first year. It's not going to happen in 2022. There's a chance if things get worse, or in 2023, there's a chance it could happen in 2024. But I honestly am in the camp that I don't think we see new all-time highs in the S&P for 10 to 15 years, actually, from here. I think Q1 is when they'll do their last rate hike. I don't know if they're going to do another 25 and then be done, or another couple 25s. But I do think that the economy significantly weakens in 2023. We're seeing the loan default spike. The signals are there that it's coming. It's almost like you see that tidal wave out in the ocean and you're like, holy crap, but you still have a little time before it hits you. But then it's going to get close here in 2023 and actually hit land. And I also think it's important to recognize that investors, like you said, most retail investors came in around COVID, right? There was that big asset run. The Fed was printing the money. They finally got lured back in the market. And so they haven't experienced a long bear market like we saw from the tech.com bubble, right? And the tech.com bubble collapsed. We saw 15 years before the NASDAQ made a new high. And the only reason I'm saying that that could be the reality of the situation is because you're losing the main driving force for the longest bull market that we've ever had in history, which was printing money. And so you have to say, unless they're going to somehow start printing money again, it's probably going to be a long time before we see new all-time highs. So it's parallel, and then I think you're going to see an inversion of it, meaning that right now there's no doubt about it. Like today, great example. Early stock market was soaring in the pre-market in the early portion. Bitcoin was trading nicely higher, and then as soon as the stock market started to sell, Bitcoin started to sell as well. So that's going to continue. The kicker for me is that I do think we have an inversion coming, where all of a sudden Bitcoin starts to take on more of a safety asset. So as you slip into recession, stocks by default will have less consumers buying their product, and their earnings are going to continue to drop. Now, fund managers are going to have to say, listen, I have to stay invested, so where do I go? Well, right now, they're not going near crypto. FTX screwed any chance of that, frankly, in the near term. But if you can get regulation in the first half of 2023, and I do think it will come in the first half of 2023, now there's transparency. There's forced transparency. Now you'll start to see institutions saying, okay, listen, earnings continue to decline, so stocks have to go down. Where am I going to put my money? Let's look at gold. Let's look at Bitcoin. And in fact, we're seeing an amazing rally on gold today, although it is off of its highs, but you're seeing some of these same things already starting to kind of coordinate. So I think that May to June is probably your low in Bitcoin. That's what I'm pricing out. And then I think it starts to slowly take on a kind of a hedge against global fear and panic and recession. Fundamental factor of Bitcoin was it started in 2009, which was when the Fed started quantitative easing. And so we're in this period now of where you don't have quantitative easing, which has been arguably one of the biggest factors in the bull run in Bitcoin, right? It means the reason why Bitcoin came into existence, to offset the printing of money. Now, I do think that eventually it does kind of go in that vicinity, but I think at this stage, the question is, does that 4-year cycle become elongated in the near term because you don't have the printing of money? And I kind of do think it will. I honestly think that this bear market, it won't be a ton longer, but I think it stretches closer to the next halving in Bitcoin than it normally does. Yeah, so I think that for me, it's mainly looking at gold and commodities right now, mainly goldish and silver type trades that aren't as reliant on economic growth. Like copper for me is I'm a little hesitant. Natural gas has been collapsing lately, so I'm a little hesitant on those type of things. But I think gold is where it's going. And all you have to do is look back at the chart. And let me show this chart here on gold, because I think it makes all the difference in the world, right? So if you look at the cycle that we are in gold here, so this is the process. So there was a 2-year run from 2018 to 2020. That was your bull run in gold. Then since then, you've had basically consolidation, right? There's this consolidatory period where gold's been going sideways to lower. That's actually what we would call a bull flag in the technical world. Now, my expectation is going to see a breakout and gold probably head towards 2,500 an ounce this year, maybe 3,000 in 2024. And the basis for that is just this. So let's go back to the 1970s, right? And again, the reason I'm using the 1970s is because it's the only time where we've seen inflation, at least in recent history, as high as what we've seen recently. And what you can see here is that, look at this parallel. So you really had about 2 years where gold inclined, 2 years of bullish consolidation, and then look at the break to the upside. I mean, this just became the bull market of the century back then, of just an incredible 10x on gold. And again, by the way, I'm not calling for a 10x on gold, but you have to look at history to kind of see what the future could be. And I think it's something to note that if you look at the gold accumulation, central banks are loading up on gold right now. And you have to take that. I mean, if they're the ones printing money and they're buying gold, we have to be like, that's kind of interesting. Maybe we should pay attention to that. And I do think eventually Bitcoin takes that on. But again, most of the Bitcoin maxis, they fell in love with the asset too early on. And again, Bitcoin was created in 2009. So you have to understand, it's only a 13-year-old or 14-year-old, right? It's not a mature asset yet. So it's still behaving very volatilely. But I do think it matures into that eventually. think you can look at what happened with Russia in terms of their invasion and how the SWIFT system was used in many ways as a weapon. I think the Chinese are very aware that the dollar is the reserve currency of the world. The Chinese are being careful and understanding that eventually the dollar may not be that reserve currency. And I think every central bank understands that they've been printing money recklessly, and these guys, they do it because I think there's a short-term benefit, meaning politically, and they have to, people are hurting, so they want to get people out of poverty and so forth. But the bottom line is they understand, and I think almost any person that's educated in this understands the long-term outcome of printing money. I mean, look at countries like Venezuela or some African countries or anywhere else, that this isn't a good thing long-term. It's unsustainable. So by buying gold, you're buying a physical asset that does for thousands of years retain its value. And I think that's their way of shoring up their own balance sheets in many ways. As of now, I'm not anticipating it. So I do know I've heard that same thing where, people are saying, oh, get ready for oil to rip back over $100 and all these things as China reopens. I'm not sold on that. The charts are definitely telling me that we're headed lower in oil. And I think it makes a lot of sense if you think about what's going on in China. So, the narrative got switched away from, oh my goodness, there's a housing collapse and crisis in China, to COVID zero policy being undone, and this is going to save the day. But you have so many economic issues in China as well that I still think it won't have the impact on oil. And I also think that if you look at the rest of the world, like let's say, and I heard the IMF came out this weekend and said that I think a third of the world will be in recession in 2023. So you have to say to yourself, okay, if a third of the world is in recession in 2023, what's the reduction in demand from that 1/3? And does that then offset the China reopening anyways? And that's the way I would lean. So I don't think there's a ton of downside in 2023 in oil, but I could see us at $65 a barrel at some point, and maybe it just hovers around there over the next year or so. So from what I read in the article from the IMF, or the statement from the IMF, they were talking about, advanced economies. So you're talking about, including Europe and the UK and Asia and the main Asian countries and so forth. So they're not talking about, some little tiny country in the middle of the ocean. They're talking about major economies that be 1/3 would be in recession. And again, I think the US is in that group. And the beautiful thing about it too is that, and this is something in bear markets give you so many opportunities, not just, whether or not these are opportunities, but like when you get a bear market, there's periods of massive panic where things get smoked, and good investors can kind of understand the technical levels on the chart. When something's declined X% in a very short amount of time, you can get short-term relief rallies, and bear markets are known for their relief rallies. So like you can look, like for instance, Apple's getting crushed these days. There will be a point where Apple gets a snapback bounce. And again, it's a little bit more on the trading side of things that I do, but there's like always good opportunities. You just have to be patient and find the levels. Yeah, so for me in my portfolio, what I'm really looking to do here is pick up some of these like EWZs on China. China has ripped recently, so there's no way I'm going back into that in the near term. But when it does pull back, I will be a buyer of pullbacks there. And then also gold miners, I think, do very, very well in 2023. So those are some other areas. And then there will be a point where I do think, things with exposure to cryptocurrencies start to become better. Coinbase has been absolutely trounced. It's actually starting to look semi-interesting down here, even though I don't think Bitcoin's quite bottomed. But there are some things where you can, for me, I start nibbling, right? I'm a nibbler. I don't go all in at one time. I kind of dollar cost average slowly on very, very good levels.